Welcome to the Stock Market Palantir. Today we are going to talk about,
MBOT.
right, Microbot Medical Inc. And this one, it presents a really complex dilemma for any kind of serious analysis.
It really does. You have a company that's right at the frontier of medical robotics with their Liberty system, but it's also stuck in the chaotic and often punishing world of small cap stocks.
And that's the conflict, isn't it? That's the central question. How should an investor actually value this thing? Is it all about the technology, the tangible asset, and their balance sheet?
Or is it about the market structure, the history of dilution, these capital overhangs, and just the raw mechanics of how the stock itself trades?
Exactly. And for my part, I'm going to argue that it's the former. I think the operational wins, the tech, the regulatory clearance, the cash, that's what will drive the real sustainable value here. The market is it's missing the plot right now.
And I'll be taking the other side. I think that no matter how good the technology is, the stock's performance is structurally inhibited. The history and the current market mechanics create a ceiling it's going to be nearly impossible to break through, regardless of any clinical success.
All right, so my core thesis is pretty straightforward. The current valuation, I believe, severely underestimates the disruptive potential of the Liberty robotics system. I mean, we're talking about a genuine technological leap here.
Okay.
It's the first FDA-cleared, single-use, remotely operated system for these kinds of endovascular procedures. And the commercial advantage of that is it's immense. You're shifting the cost basis for hospitals away from huge capital expenditures, CapEx, and turning it into a disposable operating expense. It radically lowers the barrier for adoption. And then there's the killer app, which is radiation safety.
Right, the physician safety angle.
Exactly. These doctors spend their entire careers getting blasted with radiation, wearing heavy lead vests. It leads to cancer, orthopedic injuries. Allowing them to operate from a shielded cockpit away from all that, I mean, that's a massive driver for adoption. And then you look at the financials. They have over $80 million in cash. Their burn rate is about $3.8 million a quarter. You do the math. That's a runway of over 5 years. So they are stable through a full commercial launch.
Mm-hmm.
And when you take their market cap, let's say $140 million, and subtract that $80 million in cash, their enterprise value is only around $50 or $60 million. The market is basically saying this entire FDA-cleared disruptive robotic platform is only worth $50 million bucks. That is a severe mispricing.
Okay, but my contention is that focusing on just the tech is fundamentally misleading for this particular stock. It doesn't matter how great Liberty is if the stock itself is controlled by these structural barriers that are basically designed to absorb any enthusiasm.
But those are short-term barriers.
Are they? The most immediate one comes directly from that financing you praised, the October 2025 capital raise. Yes, it got them the $80 million, but it came at a huge cost. It created a definitive structural ceiling at $4.50. That's the exercise price of the huge block of Series J preferred investment options.
They're options, though, not mandatory.
But sophisticated traders see that. They know there's a potential $63 million wall of dilution waiting to hit the market as soon as the stock gets near that price. So they front-run it. It prevents any breakout. And that's not even touching on the legacy issues, the history of dilution. I mean, this company did four major reverse stock splits between 2011 and 2018. If you add it all up, the cumulative effect is 16,200 to 1.
That was in the past. It's a different company now.
But that's not just numbers on a page. That history decimated the cost basis for every single long-term holder. It created what I'd call an entrenched trust deficit. And that deficit creates a systemic sell the news mentality every single time there's a pop. So you see, the market structure, not the technology, is what's really governing the price.
Okay, so let's anchor this in operational reality then. November 2025, the adoption of the Liberty system by Emory University Hospital. That is a massive operational validation. Emory is a premier Tier 1 academic institution. The endorsement from a key opinion leader, like Dr. Prologo. That is absolutely critical social proof you need for a full market release, which they're targeting for April 2026. That kind of real-world clinical endorsement from a top-tier center has to outweigh transient price action. I just don't think it does, not with this stock.
I agree. Emory is a fantastic headline, but headlines get absorbed almost instantly. So let me ask you, why did the stock surge on November 26th after that news, only to just fade, erasing most of the gains by the end of the day?
That's just market mechanics. Small cap volatility.
No, it's more than that. It's because the market mechanisms themselves prevented accurate price discovery. On that day, the off-exchange short volume ratio spiked to 62.99%, almost 63%, and we need to be really clear about what that actually means.
It means a lot of trading happened in dark pools. We know that. You're describing a symptom, not the root problem.
I think I'm describing the disease itself. When that ratio hits 63%, it means nearly 2/3 of the reported short volume was handled off-exchange by wholesalers, by high-frequency traders. So a retail investor gets excited about the Emory news, they place a buy order, and that order gets routed to a dark pool. The wholesaler just internalizes it, shorts against it to provide liquidity, and the buying pressure is just absorbed. It never hits the public exchange with full force. That pop and fade pattern isn't an accident. It's the direct result of this structure.
But that can't last forever. This technology solves a fundamental clinical need. That radiation exposure problem is a powerful intrinsic driver that goes beyond HFT shorting cycles. If Liberty gets adopted widely, the revenue will grow. The cash flow from disposable cartridges will eventually overwhelm those supply barriers. You can't suppress that with dark pools indefinitely.
But you're forgetting about the legacy issues. Institutional investors, the ones with the big money needed to break that 450 ceiling, they see a 16,000-to-1 reverse split history, and they see a massive red flag. They see a history of destroying shareholder value, so they stay away, they wait. And that leaves the stock vulnerable to exactly these kinds of high-frequency trading traps that you're dismissing as just, market plumbing.
Okay, but let's shift to that cash position then. $80 million. That's a 5-year cushion.
Right. And my argument is that the cushion was secured through what was effectively a toxic transaction for shareholders. It required issuing nearly 14 million new shares, and more importantly, it created that 450 Series J barrier. The strength on the balance sheet came directly at the expense of the equity value of existing holders. The company is structured for corporate survival, sure, but not necessarily for shareholder returns.
I think that's too focused on the past. Look, they haven't done a reverse split since 2018. That's a long time. It suggests they've matured. That capital raise was a trade-off, a necessary one. Secure the runway, get through commercial launch, versus some short-term dilution. And your focus on the 450 ceiling assumes that conversion is a given. They're investment options. If the market release goes well and the adoption accelerates, the momentum could push the price well past that. If the target becomes $10 or $12, that $63 million in potential dilution becomes a much more manageable factor.
That's a huge assumption about how those Series J holders behave. I mean, these are sophisticated investors. They're not in it for the 10-year clinical upside. They are interested in exercising at 450 and selling into the retail excitement that they know is structurally capped. They're incentivized to keep the lid on it. That low enterprise value isn't an opportunity the market missed. It's the market correctly calculating that the dilution risk is permanent until that overhang is gone.
I see it differently. I think that $50 million enterprise value is the market having already punished the stock for its history. We're starting from an incredibly attractive base. If this was just vaporware, fine, the EV should be zero. But it's an FDA-cleared device solving a real problem. The runway lets them execute without desperation. You're arguing the past is all that matters. I'm arguing that tech and the current balance sheet have created a clean slate, and that clean slate is priced at a $50 million EV. That is where the asymmetric upside is.
Well, this brings us to the real question then. What is the actual investment thesis here? With the history, the volatility, that trust deficit, is MBOT a truly scalable technology investment for a long-term hold? Or is it really just a short-term trading vehicle that's sensitive to HFT momentum?
I think it's the latter. The thesis has to be forward-looking. It has to be catalyst-driven. This is an asymmetric upside play. I mean, the current market cap is, what, $130 million? Compare that to an incumbent like Intuitive Surgical at over $180 billion. If MBOT captures even a tiny fraction of the endovascular market, a re-rating is inevitable. Positive data from Emory on safety and procedure times, a successful full market release, that's how you get to a significantly higher price target.
I just don't think that upside is accessible right now. The algorithms, the retail hype cycle, the moonbot narrative, followed by the inevitable selling into any strength because of that deep-seated trust deficit, it means the stock moves on momentum, not fundamentals. The prudent investor, I think, has to watch the adoption cadence. One hospital, Emory, that's a great headline. It fuels the HFTs. But 5 hospitals, 10, that's a trend. That's the kind of momentum that even the dark pools might struggle to suppress. Until then, the structural problems will keep it tethered.
To summarize my view then, I acknowledge the structural challenges. The dark pools, the Series J options, those are real resistance points. But the fundamental reality is a company with a 5-year runway and a disruptive, FDA-cleared technology that solves real problems. The current low enterprise value reflects skepticism, sure, but it also offers significant reward potential if the market release in 2026 is successful.
And my position remains that the tech, while compelling, is secondary here. The legacy of extreme dilution and the current manipulation of order flow just create an environment of inefficient price discovery and capped upside. Until that Series J overhang is gone and the company proves it can generate sustainable revenue without going back to the dilution well, the stock price will be dictated by these microstructural forces, not the value of the robot.
Well, I think both perspectives really highlight the profound complexity you find when you're valuing these companies that sit right at that intersection of capital structure volatility and legitimate clinical innovation.
Indeed. It really forces an investor to weigh the mechanisms of corporate survival against the potential for actually maximizing shareholder returns.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.